Hello, Mr. Robert Haugen, finance professor. You're very famous about the stock anomalies. Why do you think they still exist?
Because the market isn't generally informed about a lot of them, like the one I'm going to talk about today, the low volatility anomaly. And it would take massive movement in the market of trillions of dollars to get rid of this anomaly. Someday it will happen, but it's not going to happen fast.
Do you think the big developments of internet, so there's a lot of more data and information coming to new investors that will threat the anomalies?
It certainly is going to make the market more efficient, but the market has a long way to go, in my view, before it becomes efficient. So that's going to help, but it's not going to eliminate these anomalies.
Are these anomalies still stable? Because there's always change in the finance world. Question and demand are always changing.
Yes, the low volatility anomaly is stronger now than it ever has been. The January effect, for example, is still present. Even though it's been celebrated and talked about and written about, it's still here. And I intend to play it this year.
You talk about the January effect. Is it applicable to the whole world, on every market?
Yes. In fact, the results that were published back in the early 80s indicated that it was stronger in the rest of the world than in the U.S.
When we have to make a tapation, are you more a quantitative investor or a value investor?
I would say I'm more of a quantitative investor. I have in my portfolios I have a value tilt, but they're more generalized in terms of just value. For example, they tend to be invested in cheap stocks, profitable stocks, stocks that have done well over the past year, and low-risk stocks.
Is your investment style a bit comparable with Warren Buffett?
Well, Warren Buffett is a value investor, and to the extent that I am somewhat a value investor, it is.
What do you think are the most fundamental ratios you use?
The measures of cheapness, book to price, cash flow to price, sales to price, etc. Also measures of profitability, return on assets currently, return on equity, profit margin.
And what are the most differences with the Fama and French factors like size and book to market?
Well, my factors in my model are much more comprehensive. I have 70 factors that cover things from risk to liquidity to cheapness to profitability to technical history.
And how important is size in this context?
In the context of some of the anomalies, size is very important. The January effect, for example, is restricted to low-price stocks, low market cap stocks. And the volatility anomaly tends to be associated with smaller stocks.